At first glance, everything looks stable. Stock indices hover near record levels. Corporate earnings, while uneven, continue to come in. Unemployment remains relatively low by historical standards. Consumers are still spending. From the outside, the system appears intact. But stability on the surface does not always mean strength underneath. In fact, some of the most fragile systems in history looked calm just before they shifted. The key is not what is visible. The key is what is quietly accumulating out of sight. Today, that accumulation is happening inside the banking system. Not in dramatic headlines, not in emergency press conferences, but deep inside balance sheets. To understand this, we need to start with a simple paradox. How can markets trade near highs while banks are tightening credit? How can economic data look steady while financial institutions are sitting on large, unrealized losses? How can confidence appear strong when lending standards are quietly rising? These contradictions are not random. They are signals. Over the past few years, interest rates rose at one of the fastest paces in modern history. When rates rise quickly, the value of previously issued bonds falls. Banks, which hold large portfolios of government and corporate bonds, suddenly found themselves sitting on assets worth far less than what they paid. On paper, many of these losses are classified as unrealized. That means the bank does not have to recognize the loss unless it sells the asset. But the economic reality does not disappear simply because accounting rules allow it to be deferred. If a bank needs liquidity and must sell those bonds, the loss becomes real instantly. This is where the pressure begins. Banks operate on leverage. They take short-term deposits and transform them into longer-term loans and securities. When deposits are stable and rates are predictable, this model works efficiently. But when rates move sharply and depositors become more sensitive to yield and risk, the foundation becomes less stable. Deposits today are more mobile than ever. With digital banking, funds can leave in hours. A whisper can become a withdrawal wave before the market even opens the next morning. That changes the psychology of banking. Now layer in commercial real estate. Office buildings in many cities remain under pressure. Refinancing costs have surged because rates are higher. Property valuations in some segments are falling. Loans that were manageable at low interest rates suddenly look strained at higher ones. Banks, especially regional institutions, have significant exposure to this sector. At the same time, sovereign debt levels globally are near historic highs. Governments borrowed heavily during the pandemic period. As rates rise, the cost of servicing that debt increases. Higher interest expenses crowd out fiscal flexibility and add long-term strain to the system that underpins banking stability. These forces do not explode overnight. They compress. Think of the system like a bridge carrying heavier and heavier loads. From a distance, the structure appears unchanged. Cars continue crossing. Traffic flows normally. But stress fractures can form inside the steel long before the first visible crack appears. Financial stress works the same way. It builds quietly through duration mismatches, funding gaps, and leverage layers. It shows up in subtle data points, tighter lending surveys, reduced loan growth, higher credit spreads, increased use of emergency liquidity facilities. None of these signals alone suggest collapse, but together they form a pattern. Wealth destruction rarely begins with a crash headline. It begins when credit becomes more expensive and less available. Businesses delay expansion. Consumers face higher borrowing costs. Asset prices stop rising because the fuel of easy money is no longer flowing at the same rate. The shift is gradual at first, then none. The question is not whether the system is stable today. The more important question is whether the rules that kept it stable are still functioning the same way. Because something fundamental has changed. Interest rates are no longer near zero. Depositors are more reactive. Governments are more indebted. Central banks are balancing inflation control against financial stability. The old playbook assumed low rates and abundant liquidity. That assumption no longer holds. And when assumptions change, so do outcomes. This is the core disruption. Hidden balance sheet stress, interacting with a new rate environment and elevated debt levels. It does not announce itself loudly. It works beneath the surface, reshaping incentives, and tightening margins, markets can remain elevated while stress builds underneath. In fact, late cycle strength often masks early structural weakness. Asset prices reflect expectations. Bank balance sheets reflect realities that can take longer to surface. So if everything looks fine, where exactly is the strain concentrating? To answer that, we need to examine what has quietly broken in the system's normal operating rules, and why the signals emerging now do not fit historical patterns. To understand where the strain is concentrating, we have to examine what changed. For more than a decade, the global financial system operated under one dominant assumption: interest rates would remain low, and liquidity would be abundant. After the financial crisis, and again during the pandemic, central banks lowered rates to near zero and expanded their balance sheets. Bonds were safe. Duration risk felt manageable. Funding was predictable. Then the regime shifted. Inflation surged to levels not seen in decades. Central banks responded with the fastest rate hiking cycle in modern history. In a short period of time, policy rates moved from near zero to levels that fundamentally altered asset pricing. When interest rates rise, bond prices fall. This is basic mathematics. But the scale of the adjustment was extraordinary. Trillions of dollars in government and high-grade bonds declined in value simultaneously. Banks around the world were holding large portfolios of these securities. Many had purchased them during the low-rate era, locking in yields that looked reasonable at the time. When rates jumped, the market value of those bonds dropped sharply. On financial statements, these losses were often categorized as unrealized. That accounting treatment allowed institutions to avoid immediate recognition of the full impact. But the economic exposure remained. If deposits stayed stable, banks could hold those bonds to maturity and recover their face value. The system could absorb the shocks slowly, but that assumption depended on depositor behavior staying calm. This is where the rules began to break. Deposits are no longer sticky in the way they once were. In a digital world, funds can move instantly between institutions. A customer can shift millions with a few taps on a phone. Information spreads even faster. Concerns that once took weeks to circulate can now move across social networks in minutes. This changes the speed of banking risk. Historically, bank runs formed physically. Lines outside branches signaled trouble. Today, withdrawals can occur silently and at scale before most people are even aware of the pressure. When deposits leave, banks may be forced to sell assets. If those assets are underwater bonds, unrealized losses turn into realized ones. Capital buffers shrink quickly. Faced with this dynamic, central banks introduced liquidity backstops. Emergency lending facilities allowed banks to borrow against bonds at favorable terms, often valuing them closer to par than market price. The intention was clear: prevent forced selling and stabilize confidence. But this created a new contradiction. On one hand, central banks were raising interest rates aggressively to fight inflation. On the other hand, they were quietly providing support to institutions under stress from those same rate hikes. This dual mandate reshaped market discipline. In a traditional tightening cycle, higher rates reduce risk-taking and expose weak balance sheets. Institutions that mismanaged duration or leverage would face consequences. But when backstops are introduced, the boundary between tightening and support becomes blurred. Markets begin to price in rescue mechanisms. That is the big signal. The system is no longer operating under a single objective. It is attempting to restrain inflation while preventing instability. These goals can conflict. Tightening drains liquidity. Backstopping injects it. Fighting inflation requires restraint. Preserving banks often requires accommodation. Investors grew accustomed to a clear framework. When stress appeared, policy would ease. When growth slowed, rates would fall. That pattern held for decades. Now, the framework is unstable. If inflation remains persistent, central banks cannot simply cut rates at the first sign of stress. If they keep rates elevated, pressure inside bank balance sheets intensifies. The margin for error narrows. This is not a one-off event. It represents a structural regime shift. Duration risk is no longer theoretical. Funding is no longer guaranteed to remain cheap. Deposits are more sensitive. Governments are issuing more debt at higher yields. The cost of capital has reset. Even the definition of risk-free assets has changed. Long-dated government bonds, once considered stable anchors, proved highly volatile when rates adjusted. Portfolios built on the assumption of steady yields experienced sharp repricing. The traditional 60/40 framework struggled in ways many investors had not seen before. And perhaps most importantly, confidence is now more fragile because information travels instantly. In this new environment, small cracks can widen quickly. Liquidity facilities can contain pressure temporarily, but they do not erase the underlying mismatch between loyal legacy assets and higher funding costs. This is why banking stress cannot be viewed as an isolated crisis event. It is embedded in a broader transition from one monetary era to another. The old rules, predictable easing cycles, slow deposit flows, stable duration assumptions, are no longer reliable guides. And when rules change, power shifts. Because beneath interest rates and liquidity programs lies a deeper layer of the system. One tied not to financial engineering, but to physical supply chains, energy flows, and geopolitical leverage. Because beneath interest rates and liquidity programs lies a deeper layer of the system, one that does not trade on screens. Finance sits on top of the real economy, and the real economy runs on energy, materials, labor, and logistics. If those foundations tighten, the financial structure above them begins to strain. Over the last several years, global supply chains have shifted in ways that are still unfolding. For decades, efficiency was the dominant goal. Production moved to the lowest cost regions. Just-in-time delivery minimized inventories. Trade routes expanded. Capital flowed freely across borders. That era is changing. Geopolitical tensions have encouraged countries to rethink dependence on distant suppliers. Energy security has become a national priority. Critical minerals, lithium, copper, rare earth elements are increasingly viewed through a strategic lens rather than a purely economic one. This is resource nationalism. Nations are seeking control over the materials and infrastructure that power modern economies. Export restrictions, tariffs, sanctions, and reshoring efforts are reshaping trade corridors. Supply chains are becoming shorter, more redundant, and often more expensive. Efficiency is being replaced by resilience. But resilience has a cost. When energy prices spike, transportation costs rise. When shipping lanes are disrupted, delivery times extend. When manufacturing shifts to higher cost regions, margins compress. These pressures ripple through corporate balance sheets. And corporate balance sheets connect directly to banks. A loan extended to a manufacturer assumes predictable input costs and steady demand. A commercial real estate project assumes stable tenants and manageable refinancing conditions. An energy company's debt structure assumes certain commodity price ranges. When supply chains fragment and volatility increases, those assumptions weaken. Banks are not just holding bonds and mortgages. They are deeply intertwined with the operating health of companies exposed to commodity swings, logistics bottlenecks, and shifting trade policies. Consider energy flows. Modern economies depend on stable access to oil, natural gas, and electricity. Disruptions, whether from conflict, policy shifts, or infrastructure constraints, can drive sudden price movements. Higher energy costs act like a tax on businesses and consumers alike. That reduces disposable income, pressures profit margins, and slows growth. Slower growth affects cash flows. Weaker cash flows increase credit risk. Now layer in refinancing risk. During the Laureate era, corporations issued debt at historically cheap levels. Many loans and bonds will mature over the next few years. Refinancing at higher rates increases interest expense, sometimes dramatically. If revenue growth does not keep pace, leverage ratios deteriorate. Banks that financed these firms face rising default probabilities. Even if defaults remain contained, lenders may tighten standards preemptively, slowing new credit creation. This is how real economy stress feeds back into the financial system. The headlines often focus on market movements, stock volatility, bond yields, currency swings. But the deeper leverage lies in production capacity, transportation networks, and resource access. If a critical mineral supply tightens, the impact may show up months later in manufacturing output. If a shipping corridor is disrupted, inventory cycles adjust slowly before financial data reflects the strain. By the time credit spreads widen meaningfully, the real shock has already occurred. Power, in this context, resides with those who control energy sources, logistics hubs, and strategic commodities. Financial markets react, physical supply chains dictate. When supply chains were smooth and global trade expanded steadily, credit risk felt manageable. Growth supported debt expansion. Globalization suppressed costs and inflation. Now fragmentation introduces friction. Friction increases volatility. Volatility increases uncertainty. Uncertainty changes lending behavior. Banks, aware of these dynamics, begin adjusting quietly. They reassess sector exposures. They increase provisions. They demand stronger collateral. None of this makes headlines at first, but it shifts the tone of credit availability. The real battle, then, is not between bulls and bears on a trading floor. It is between a financial system built for hyper-efficient globalization and a world moving toward strategic competition and supply constraint. If financial collapse were ever to emerge, it would likely begin here in the real economy before appearing in market prices. And once that pressure migrates into credit markets, it does not stop at corporate loans. It begins to challenge currencies, sovereign debts, sustainability, and the credibility of money itself. And once that pressure migrates into credit markets, it does not stop at corporate loans. It begins to challenge currencies, sovereign debt, sustainability, and the credibility of money itself. At this point, the story moves beyond individual banks. It becomes about the architecture of the monetary system. Banks sit at the center of credit creation, but currencies anchor trust. When stress builds inside financial institutions, central banks face a difficult balance. They must maintain confidence in the currency while preventing instability in the banking system. These goals can reinforce each other or collide. Consider sovereign debt. Governments around the world increased borrowing dramatically in recent years. Emergency spending, stimulus programs, and structural deficits pushed debt levels to historic highs. When interest rates were near zero, the burden felt manageable. Servicing costs were low. Markets absorbed new issuance with little friction. But higher rates change the equation. As older debt matures and is refinanced at higher yields, interest expenses rise. A larger share of tax revenue goes towards servicing debt rather than funding infrastructure, defense, or social programs. Fiscal flexibility narrows. Investors begin to watch sustainability metrics more closely. If confidence weakens, yields rise further. That increases costs again. The feedback loop tightens. Now place central banks inside this dynamic. On one side, they are fighting inflation, which erodes purchasing power and undermines currency credibility. On the other side, aggressive tightening increases stress for banks and governments carrying large debt loads. If they keep rates high, financial strain deepens. If they ease too quickly, inflation pressures may return and the currency may weaken. This is the tension. The US dollar remains the dominant global reserve currency. In times of uncertainty, capital often flows toward it. A stronger dollar can help suppress imported inflation domestically, but it also increases pressure on emerging markets that borrow in dollars. Their debt becomes more expensive in local currency terms. Global reserve dynamics are slowly evolving. Some countries are exploring alternative payment systems and bilateral trade arrangements to reduce reliance on the dollar. These shifts are gradual, not abrupt, but even small reallocations can signal changes in long-term confidence. Meanwhile, central bank balance sheets remain large by historical standards. During crises, they expand to stabilize markets. During tightening cycles, they attempt to shrink. But balance sheet reduction is difficult when financial stress quiet forms of monetization can emerge. Governments issue debt. Central banks, directly or indirectly, absorb portions of it through asset purchases or liquidity programs. The process may not be labeled as such, but the effect is similar. Money creation supports sovereign financing. This does not automatically lead to runaway inflation. Monetary outcomes move in cycles. Periods of liquidity injection can coexist with credit contraction in the private sector. Asset prices may rise while bank lending slows. Inflation can cool in goods while persisting in services. The system is not binary. It oscillates. Wealth destruction in this environment rarely looks like a single crash. It appears through repricing. Bond values decline when yields rise. Equities adjust when earnings weaken or discount rates increase. Real estate shifts when financing costs climb. Currency debasement can occur gradually if money supply expands faster than productive capacity. Alternatively, deflationary forces can dominate if credit contracts sharply. These forces can even alternate over short periods. For investors and institutions, this creates confusion. Traditional correlations break down. Safe assets become volatile. Risk models based on past decades lose reliability. Trillions of dollars in wealth can be revalued without dramatic headlines. Pension funds holding long-duration bonds experience losses. Governments face higher financing costs. Corporations adjust capital spending. Households see purchasing power fluctuate. The consequences accumulate quietly. The key insight is this: banking stress is not isolated. It feeds into currency, credibility, sovereign debt, sustainability, and the long-term structure of money. When leverage is high across the system, small shifts in rates or confidence can cascade through multiple layers. And yet, from the outside, daily life may appear unchanged. Paychecks still arrive. Stores remain open. Markets continue trading. The deeper transformation unfolds gradually, which raises a more personal question. If these structural forces are reshaping credit, currency, and asset values over time, how does that translate into everyday financial reality? And what frameworks can help individuals understand the risks without overreacting? Which raises a more personal question. If these structural forces are reshaping credit, currency, and asset values over time, how does that translate into everyday financial reality? Systemic stress rarely announces itself in daily headlines. It shows up in quieter ways. A small business owner applies for a loan and faces stricter terms. A homeowner looking to refinance encounters a higher rate than expected. A company delays hiring because financing costs have increased. These are not dramatic events, but together, they shape the economic environment people live in. When banks tighten lending standards, credit availability declines. Even borrowers with solid financial histories may face more documentation requirements, higher collateral thresholds, or shorter loan durations. The supply of credit becomes more selective. Small businesses feel this quickly. Many rely on lines of credit to manage cash flow. If those lines are reduced or repriced, expansion plans slow. Hiring decisions are postponed. Investment in equipment or inventory becomes more cautious. Mortgage markets reflect similar pressures. Higher interest rates increase monthly payments for new buyers. Demand cools. Home prices may stabilize or decline in certain regions. For homeowners with adjustable rate loans, rising payments reduce disposable income. Job markets adjust gradually. When companies face higher borrowing costs and uncertain demand, they protect margins. That can mean slower wage growth or selective layoffs. None of this necessarily signals collapse, but it shifts momentum. Retirement portfolios also respond to structural change. Bonds, often viewed as stable anchors, can lose value when yields rise. Equities can struggle if earnings weaken or discount rates remain elevated. Asset allocation models, built during the Laureate era, may behave differently under new conditions. Understanding this environment requires mental models rather than predictions. The first model is the leverage pyramid. At the base of the pyramid sits real economic activity, production, labor, consumption. Above it sits corporate debt. Above that, financial institutions. At the top, derivatives and structured products. A small shock at the base can be amplified as it moves upward through layers of leverage. If energy prices rise or supply chains tighten, corporate cash flows compress. That affects debt service. Banks holding that debt adjust capital buffers. Investors holding bank equity react. The shock grows as it climbs. The second model is liquidity versus solvency. Liquidity refers to short-term funding. Solvency refers to long-term viability. A bank can be solvent in theory. Its assets exceed liabilities over time, but face immediate trouble if depositors withdraw funds quickly. Central banks can provide liquidity support, but they cannot permanently fix solvency problems without structural adjustment. Distinguishing between these two concepts helps reduce confusion when headlines report emergency facilities or rescue programs. The third model is the confidence loop. Banking is built on trust. Depositors trust that their money is safe. Investors trust that institutions are stable. When confidence is strong, the system functions smoothly. When doubt spreads, behavior changes. Withdrawals increase. Lending slows. Asset prices adjust. Perception can drive reality in finance. The fourth model is duration risk. Duration measures sensitivity to time and interest rates. Long-duration assets, such as long-term bonds or real estate financed at fixed low rates, are more sensitive to rate changes. When the interest rate environment shifts rapidly, duration becomes a hidden vulnerability. What looks stable under one rate regime can become volatile under another. These frameworks do not predict outcomes. They clarify relationships. They allow individuals to observe signals without overreacting to noise. Instead of asking, "Is collapse imminent?" a more useful question becomes, where is leverage concentrated? Is this a liquidity issue or a solvency issue? How is confidence behaving? What assumptions about time and rates are embedded in valuations? Systemic shifts rarely unfold in straight lines. There will be rallies and recoveries. Periods of calm may return. But underlying structures matter more than short-term price movements. For everyday people, the impact may not feel dramatic at first. It may feel like slightly tighter credit, more expensive financing, slower growth, or reduced portfolio gains. Over time, however, these incremental changes compound, and that brings us to the next stage of the story. If these pressures continue to build across banks, supply chains, sovereign debt, and currencies, what paths could the system realistically take from here? If these pressures continue to build across banks, supply chains, sovereign debt, and currencies, what paths could the system realistically take from here? No one can predict the exact sequence, but we can outline plausible scenarios based on incentives, constraints, and historical patterns. The first path is gradual. In this scenario, banks continue tightening credit slowly. Lending standards remain elevated. Businesses scale back. Expansion. Consumers become more cautious. Economic growth softens, perhaps tipping into a mild recession. Asset prices adjust, but not violently. Equity markets reprice earnings expectations. Commercial real estate valuations decline in segments with oversupply. Bond yields stabilize as inflation cools, but remain structurally higher than in the previous decade. There is no dramatic collapse. Instead, there is a slow bleed of excess leverage from the system. Debt levels come down gradually relative to income. Risk-taking becomes more selective. The adjustment is uncomfortable but controlled. Historically, this kind of environment can last several years. Wealth is not destroyed overnight. It erodes through repricing and lower returns. Investors recalibrate expectations. Governments manage deficits carefully, but fiscal flexibility remains constrained. The second path is a policy pivot. In this scenario, financial stress intensifies enough that central banks shift course more decisively. Liquidity facilities expand. Rate cuts arrive sooner than anticipated. Balance sheets grow again, even if temporarily. The goal would be to stabilize credit markets and prevent contagion. But this pivot carries consequences. If inflation pressures have not fully subsided, renewed liquidity could reignite price increases. Currency values may weaken relative to hard assets or alternative stores of value. Capital flows may adjust as investors reassess real returns. A policy pivot can calm markets in the short term while creating new, long-term distortions. Asset prices may rebound sharply. Risk appetite may return. Yet underlying structural imbalances, high sovereign debt, supply chain fragmentation, geopolitical tension remain unresolved. The third path is a shock event. This could take many forms. A wave of commercial real estate defaults that overwhelms regional banks. A sovereign debt scare in a major economy that rattles bond markets. The failure of a large financial institution that triggers rapid reassessment of counterparty risk. In a highly interconnected system, contagion can move quickly. Credit spreads widen. Equity markets reprice sharply. Emergency measures are introduced under pressure rather than preemptively. Even here, outcomes are not predetermined. Shock events can lead to deeper reform and stronger capital buffers over time. But they can also accelerate wealth repricing across multiple asset classes. Across all scenarios, one theme remains consistent. Wealth destruction often occurs quietly before headlines catch up. It unfolds through tighter credit, slower growth, currency shifts, and valuation adjustments. By the time the story dominates news cycles, much of the repricing has already occurred. Uncertainty is not a flaw in the system. It is a feature of complex economies. Probabilities shift as new information emerges. Policymakers adapt. Markets respond. Feedback loops evolve. The key question is not whether one specific outcome will occur. It is whether the financial system is transitioning into a new structural era. If leverage is higher, supply chains more fragmented, debt more expensive, and currencies under greater strain, then the assumptions that guided the last decade may not apply to the next one. That raises a deeper question. If the rules governing money, credit, and globalization are shifting, what does wealth preservation actually mean over the coming decade? Does it rely on financial assets alone? On geographic diversification? On exposure to real assets tied to energy and materials? These are not questions with simple answers, but they are questions worth exploring carefully. Because if the system is entering a structural transition rather than a temporary cycle, understanding the foundations of money itself, its anchors, its alternatives, and its vulnerabilities becomes essential. And that is where our next conversation begins.